Hey, thank you so much for checking the channel out today. My name is Agabus. This is your financial education channel. Today, we've got some new reports around inflation for the year. Let's take a look here at CNBC reporting. Key federal inflation gauge rose 0.3% as expected in September. Spending tops estimate. Inflation accelerated in September, but consumer spending was even stronger than expected, according to the Commerce Department report on Friday. Today, core personal consumption expenditures price index increased by 0.3% for the month, in line with the Dow Jones estimates, but above 0.1% for August. Even with the pickup in prices, personal spending kept up, some places rising 0.7%, which is higher than the 0.5% forecast. Personal income also rose by 0.3%, not keeping up with the price of living. The Fed focuses more on core inflation on the belief that it provides a better snapshot of where prices are headed over the long term. Core PCE peaked around 5.6 back in 2022 and has been on a downward trajectory since then to get to the Fed's target of 2%. The Fed prefers PCE as its inflation measure as it takes into account changing consumer behavior, such as substituting lower priced goods as prices increase. This is the last inflation report the Fed will see before its two-day policy meeting next week. Traders are pricing in a near 100% chance that the central bank will announce no rate hike when the meeting concludes next week. Let's keep our fingers crossed, though. However, if we go across the world over into Russia, they are having some immediate problems with their inflation. This morning, Russia raises interest rates to 15% after a steep climb in inflation. Over here at The Guardian, Russia's central bank has increased interest rates by more than expected to 15% after a steep rise in inflation. Inflation jumped to 6.5% from the previous month of 6%. And even with the increase in borrowing costs, inflation is expected to carry on climbing to 7.5% by the end of the year, the central bank said, before falling back to 4% next year. Again, the issue with all of these different countries and all these banks is that when you're manipulating and changing the supply of the money and you dramatically increase it, you get inflation because there's more money chasing the same amount of goods and services. So all banks across the world are now in this predicament where they have to raise rates to slow the spread of that money that they just printed in order to fight the inflation. The world is at a restrictive moment because of all the printing and pumping and pushing into the financial sector we did a couple of years ago during the pandemic. Now they're trying to fix the problem that they created due to that response. Every country around the world is having the same issues. Some are doing better with the others. Let's just keep our fingers crossed that these problems don't turn into some phenomenal issues like we saw stagflation in the 70s and 80s in the US and a depression back in the 30s because the central bank created the burst in the 20s and then had to try to fix it in the 30s, creating the depression. Thank you so much for checking in the channel today. That's all I got for you today on this Friday, just the inflation print. We'll keep our eyes on it going forward. Cross our fingers for next week that they don't raise rates and inflict more pain on the economy. That's just my 2 cents today. Thank you so much. Drop your 2 cents in the comment below. As always, stay informed, stay inquisitive, and stay subscribed for more. We'll see you tomorrow.